Hey Brian, it's great to see you.
Hi, Mike. Good to see you too.
Well, I'm excited for our podcast today. What's going to be our topic?
Today we're talking about so if I'm a, well, we're talking about inheriting retirement accounts, traditional IRAs, 401ks in particular, the rules kind of surrounding it, and how to make sure that, honestly, from two perspectives, as a beneficiary, what do I have to do as a beneficiary to make sure I get that money out and in compliance? And then an owner of the account, before you pass away, what are some things that you can do to ensure that your beneficiaries get good tax advantages and make it a good, um, good money that they can inherit from you?
So, there's different rules for inheriting an IRA. Is that the key gist of what we're going to break down today?
Yeah, that's really about it. Making sure that people understand how to go into it. And I think that where we should start is explaining what used to be the rule. Kind of go from there and then say how it changed because it has changed recently. And then going into those changes. And so, making that work.
So, before we go through the old rule and what the new rules, why do our listeners care about these changes? Why should they care?
It's a really good question. These are assets that a lot of people have. Retirement accounts, 401ks, IRAs. Like you say that, most people know what it is. They accumulate money through their work life. Um, the idea is, hey, this is retirement money. Hopefully, you can use it in retirement. That's the goal. But a lot of times, there's a lot of money in these accounts. It's gonna go to a beneficiary most likely upon your death. I mean, the amount of clients that I have, 90% have these accounts. Like that's a really guesstimate number. Like I don't know, but it's a lot of people.
I would be
They
shocked
have
if
this.
I'd be shocked if it's less than 90%. Yeah, almost
Yeah,
everyone we talk to has some type of IRA or 401k.
yeah.
Um, so they have the account, but why do they care about the rules that changed with the accounts? Like, I mean, at, at the bottom line, like, um,
What does this come down to?
yeah, like, why should they? I mean, they can just right, they can just let their advisor or their attorney worry about the rules. Why should they care about the rules?
That's a really good question. I think I what it comes down to is taxes. That's that's everyone's favorite word, right? Is taxes. Like when you hear taxes, okay, you should people perk up a lot, but
Mhm.
there are taxes associated with these accounts, and the rules revolve around the taxes and how it will affect the taxes, the beneficiaries. It's really making sure that we can keep taxes low for people, and make sure that they're not paying more than they need to. Whether you're a beneficiary or, well, really the beneficiaries of these accounts, really just making sure that um, they have the greatest tax advantage possible to them.
Yeah. So, and kind of the reverse of that, right? If we pay less taxes, then we're maximizing the inheritance that we're providing for our family. So, I think there's a lot of reasons they should care, but at the end of the day, by understanding these rules, you're going to increase the amount of money you leave to your family, and you're going to also prevent from making some, mistakes that can add up quite a bit.
Yeah, for sure.
So, what's the old rule? If I'm leaving an IRA or a 401k to someone, what did the old rule say? That they got it tax free?
Not quite tax free. Really, the situation that we're mostly looking at today is if my spouse has passed away, I passed away, my kids are inheriting the money. And there's no special needs or anything like that. My kids are able to, they're financially dependent and independent. They can handle this. Like that's the case that we see the most in a lot of people. The old rule, these children, they were able to take out the money from these accounts over their lifetime. And before we really get into that, if there's so these are accounts, the 401k, the traditional IRA, when you pull the money out in retirement, you still have to pay those taxes on the accounts. Like there's it just hasn't been paid yet. It's money that was put into the accounts before tax, like the income tax was taken out. So when you take the money out, those taxes still have to be paid. If there's money in those accounts when you pass away, which is likely to happen, your beneficiaries still have to pay those taxes as well. Um, and again, so kids, they used to have their whole lifetimes to be able to figure out, hey, I'm going to take out the minimum that I can. I need some money. I can take out the minimum that I can, but it won't affect any of my taxes because I got my whole lifetime to worry about this. If my parents passed away, I'm 36 right now. If they passed away today, I'd be 36. I would probably have another 30, 40 years to really try to get this money out, which is a good amount of time to really plan and think about, hey, this is money that can stay in there, it can keep growing, and I don't have to worry about paying too high taxes as I pull it
So,
out.
so when I inherit the IRA, I don't have to pay the taxes on it. It's when I actually take the money out of the account that I
Correct.
have to report it as income.
Yeah, yeah. When you take it out of the account.
So under the old rules, you could leave it in the account for your whole lifetime and just take a little bit out each year.
Yes, yes. That's the old rule. The new rule, we call it the Secure Act. It was passed in 2019. It's federal. It applies to everyone in the land.
Wait, 2019, that doesn't sound new. That's like 7 years ago.
There's Secure Act 1, which is where this came into place, and there's Secure Act 2.0, which came out a couple years later.
Okay.
And we'll get into kind of those rules here in a minute too. But under the Secure Act 2019, instead of for children to receive their inherit to pull out that money from those accounts, instead of that lifetime, children now only have 10 years to pull all that money out. So
Okay. So
yeah,
so they're making us pull it out sooner because then they get to tax it sooner.
correct. Yeah.
Okay.
That's the whole reason why instead of being able to pull it out and think about taxes over your whole lifetime, now you got 10 years to think about, hey, what's the best advantage I have to pull the money out to try to keep taxes.
Just to be clear, that's for people who inherited an IRA. That's not for the person who it's their own IRA.
Correct. People who are inheriting IRAs, and there's exceptions to that. Like we're not talking about spouses. Spouses still have their whole lifetime to pull out money from an inherited IRA. Children who are disabled, they have an exception as well. Children who are under age 21, um, they have the exception as well until they're 21, and then the 10 years applies. So there's exceptions to the rule, but like again, the majority of beneficiaries, well, I shouldn't say the majority, but a lot that we see come through the office at least, I want my kids to be the beneficiaries when I pass away. This would apply in a situation like that.
Cool. So, um, the the new rule, do you think it's good, bad? Like, what's kind of like? I mean, what's her vibe on it?
If I was the government, from my perspective, hey, yeah, I'm forcing people to pull money out faster, which means I get more in taxes, um, and more revenue through taxes, right? So if I was the government, I think they really like it. From just a normal American everyday, it's a little bit more planning involved. Instead of being like, oh, I can just go in and take it out when I need it, you got to think about more and think about, hey, when exactly like how much do I need to take this year to make sure that, or like what's the minimum, what's the amount that I can take that I don't go into a higher tax bracket, I can stay in the tax bracket I'm in, and things like that. Like there's just more strategies and more thinking, more people involved to try to make sure that you do what's right and you do what's best to get it right for you.
Yeah, I mean, I think if you're the person inheriting the IRA, it's not it doesn't help you at all. You're just gonna have to.
Yeah.
Well, you could instead of leaving the money in, growing tax deferred, you have to take it out and pay taxes on it sooner. It is what it is. But the act had some trade offs. They did some other things to help with the retirement numbers. So I think when they were assessing like, do we want to? Because one of the nice things they did is you used to have to take the money out of your IRA when you hit 70 and a half, right?
Mm-hmm.
But now they said, no, you can wait till you're older. I think 73 is
That's 73. If and that's if you're born in a certain time period. It's going to go up to 75 soon too, but 73.
Yeah, so like if you're working longer, you're healthier, you're not retiring, and you don't want to start pulling your money out and paying taxes on it, you can wait till you're 75, 73, whatever rule ends up applying to you. So that was a nice perk, but on the offside, to offset that, they said, okay, the retirement account is more about the person who's retiring. It's not as much about their heirs, right? So um, it feels like a little bit, it was they had to do a little give and take, and it's easier to take away from the person who's inheriting than it is to take away from the person who worked hard and earned all that money. That's my read on it.
I think you're right on with that. To be honest, it makes sense for sure.
So with the new rules, well, yeah, let's kind of go through the new rules a little more about like some of the nuances of what people should know so they can decide how they're going to handle their retirement money.
Yeah, some big things. First off, the big thing to remember is that we're talking about accounts where there's still taxes that have to be applied. So 401ks, traditional IRAs. If it's a Roth IRA, the 10 years still applies. Um, but I mean, like you have a little bit more leniency and be able to think about when you can take money out because you don't have to worry about when you pull the money out having to pay taxes on it because in the Roth that tax has already been paid. Um, so that's really those are the accounts that we're really looking at are like traditional IRAs and 401ks with these rules. Um, you mentioned it. If the account owner, if they like, there's a certain age when you hit that age, you're required to take out a distribution. It's called required minimum distribution or RMDs is kind of the acronym that we say for the
Yeah.
RMDs.
Most of our listeners have heard that probably. If you haven't, you will when you get
Exactly. If the account owner passed away before they were taking RMDs, though, the beneficiaries at that point they have 10 years, but they don't have to take a required minimum distribution starting at year 1 through year 9. Like they can wait until year 10 if they really wanted to take all that money out.
So
However,
that's if the person passed away before they started taking their requirement. So
correct.
in theory, if they passed away before 75,
Yeah.
the person who
Yep.
inherited it doesn't have to start taking any money out. Okay.
Exactly. Um, I mean, with our aging population, I mean that's going to happen, but a lot of times people are going to be over 75 as well now. And so the rule is that if the account owner was taking out required minimum distributions, and somebody's now going to inherit the account and and have that money, the beneficiary is also required to take out a required minimum distribution years 1 through 9 at least. Year 10, you just have to take it all out at that point. But years 1 through 9, there's a required minimum distribution that you have to take out as well.
Okay.
That's really the newest part that came out that they finalized in 2024. Is clarifying that as like where we're supposed to be about these required minimum distributions, and the IRS came out and said if the account owner was taking them, the beneficiaries have to take them as well.
So they so they have to take out whatever that required minimum distribution is, so they lose the 9 years of growth or 6 years of growth, whatever year they take it out, right? So all the money I had to take out in year 1 after my loved one passed away, that could have been growing tax free, tax deferred at least.
Yeah.
But so if it was $10,000 I had to take out, that $10,000 doesn't get to sit growing tax free for 10 more years.
That's exactly right. So, and the amount that to calculate the required minimum distributions, there's calculators out there. There's people that can help with that, financial planners. I don't actually know the calculations myself, but like it's something you can figure out. There's no exact number for every single person. It's different for everybody.
There's like a table they use to determine how much you got to start taking based on your age.
Yeah.
So with a Roth is the same thing. You have to start taking it out over the 10 years.
So that's what's cool about Roth. For for Roths, you don't have to take out required minimum distributions. Um, Again, it comes back to this is money that the tax has already been applied, so the IRS is not as concerned, is my opinion, that of you taking out the money when you need to. You do have to take out within 10 years though, but there's no required minimum distribution requirements with that for the Roths.
So why don't they do that? I wonder. They don't require minimum distribution because they don't get to tax that money, but it still gets to sit in there growing tax free longer.
That's true. I think it just comes down to it's growing tax free. Um, but again, they've already taken their tax. They've already taken it. They've already taken what is their portion. So at that point, it's when you pull the money out, you don't have to report it on your income anyway. So it's money that's there anyway, but you don't have to report it.
Probably, yeah. I mean, it's because let's if I had a Roth and I had to take $10,000 out in year one, well, if I'm probably going to reinvest it in something that's potentially generates taxes, right? Like if I put it in a CD. So if I did have to take it out in year one and I reinvested it, the government gets to earn taxes on that reinvestment. Um, but since they don't have that rule for the Roth, they have to, I won't take it out of the Roth till year 10 if I'm smart, and then I'll reinvest it. So they kind of give up 10 years of the reinvestment income. I'm guessing that was a small enough number that they didn't care enough to do it, but I'm kind of surprised they didn't do it.
Yeah, I don't know. We'll probably maybe we'll see a change later on. I don't know. I mean, for for my generation, well, I'm not gonna say for my generation, but like I know a lot of people who contribute just to Roths. Like they've forgotten like traditionals and 401k. A 401k is can't really that's up to the business, right? But at least like traditional versus Roth IRAs, I know a lot of people who are just contributing to the Roths right now instead because they want to have that tax advantage later on.
So that brings up kind of the key question that everyone I think has read or saw or have maybe pondered if you're close to retirement, and is that's, should I convert my traditional IRA to a Roth IRA? Is that worth it? Does it make sense? And there's more that goes into that decision. Um, and what we're talking about today is one piece of that, right?
Yeah,
If you decided to convert to a Roth, that's going to change how your family inherits that money versus if you keep it traditional. And so, what's some of the? I mean, why does that? How does that impact some of the decision? Like, what's some of the things that our listeners should be considering as they're like thinking through the
yeah.
beneficiary rules?
One thing to think about for if we should do a Roth conversion, one thing to think about is, the account holder. Usually it's later in life, and income tax brackets are a little bit lower. So there might be an opportunity there to and compared to your kids' but tax brackets. Let's put it that way. Usually, kids are in the peak earning area time of their lives. Like their tax brackets are maybe higher, just depending on their income and whatnot. But they're most likely going to be in higher tax brackets when a parent who's retired is now in lower tax brackets. So if the idea, I mean, this is purely based on taxes, right? If the idea is we need to pull the money out at some point anyway, is it better to pull it out during the parents' lower tax brackets years, or is it going to be more beneficial to keep it in the account and it has to come out in the children's higher tax brackets later on? So that's one thing that people can think about is like, hey, it makes sense. Maybe now let's take it from the traditional to the Roth, do the Roth conversion. You'll have to pay the taxes on it, but you're in a lower income tax bracket. So maybe it's better to do it then versus later on.
So if their kids are, yeah, if you think you might pass away when your kids are somewhere in like their 50s, 60s, they're probably in their highest earning years. They probably have not a lot of tax deductions because their kids are out of the house. Their house might be paid off, right? They don't have a mortgage deduction, whatever, right? So at that point, um, if they inherit the IRA when they're at their highest tax bracket, they might pay 35% on those inherited IRA money.
Right.
And so if I'm retired and I have more of a fixed income, and let's say I'm more at like a 22% tax bracket, then we're taking, we're taking the difference. Would we rather pay 30% tax on this money or 22% tax on the money? That's an 8% difference. That's part of the calculation, I guess, in whether or not to convert to a Roth IRA sooner or wait or never do it.
Yeah. I mean, again, too, it comes down to the an account owner has their whole lifetime to pull the money out and to be able to make those decisions versus, again, children, they have 10 years. So obviously nobody knows when they're going to pass away, but you can still have many years left to be able to convert that money over from the traditional to the Roth, and be able to make decisions over your timeline, over your life, versus, again, we're forcing children to now take it within 10 years under the
Yeah.
new rule.
Well, and that's kind of the idea, right? Like if I'm in a 20% tax bracket and each year I can take $30,000 out without bumping into the next tax bracket and put it into a Roth IRA, then, over 10 years, I get quite a bit of money into my Roth IRA at a lower tax bracket for my kids. The math usually looks pretty good. There's some pretty sophisticated calculators out there where you can like do scenarios and run all the math, and you can, assuming, a 5% return on my money over these years if I do this conversion. But I think a big key factor is, okay, when I leave the money to my beneficiaries, do I think they're going to take the money out right away, or do I think they're going to wait 10 years? What sense do you get most kids do? I have an opinion on this, but I'm curious what you have got seen most people do.
I I don't hear much from beneficiaries, or at least not yet in my practice. I will say though, a lot of owners, a lot of clients that come in, they all think their kids are just going to take the money out in year one, and just like be done with it. Hey, I want my money. I'm going to live my life and go enjoy. I have not seen in practice what usually happens. Um, but I know that's what a lot of my clients think is that, hey, we're just gonna take out year one and take the tax hit and then enjoy the money.
Yeah, there was a study once that said something like 80% of people, or 85, it was 80 or 85 percent of people just take the money all out in year one. Um, but I've seen quite a few. I mean, I don't know if quite a few, but I would say 5 to 10 clients a year have an inherited IRA that I meet with. They inherited it and they are taking it. Now, some of those people were under the old rules, so they get to stretch it for
Right,
time.
right. I met some of them too.
Um, so I mean, I feel like that study seems maybe a little higher than what really happens. I really don't think that that's almost, 8 out of 10 take the money out. But you do got to think about, if I have $100,000 IRA and I have 5 kids, each kid's getting $20,000. I mean, is it easier just to cash it out and just pay the taxes,
Exactly.
right? In that case, yeah. But if I have one kid and I have a $500,000, then they are going to save a lot of taxes if they defer the taxes over the 10 years.
Yeah, I agree. That's something I look at too with these, and when I'm talking about with clients in this rule is, yeah, looking at how much is each kid going to get if there's multiple kids or not. And
Yeah, so those are two really big factors as you're deciding how you're leaving the money to your beneficiaries for your IRA. Is if you have more kids, it dilutes what everyone's inheriting, and then the smaller the retirement account, the less impact the taxes have.
right.
So what else about inheriting IRAs do we want to cover today, Brian? I'm just checking our list to see if I forgot anything.
just one thing that I just want to make sure is clear. Spouses, again, if spouses are inheriting, they can stretch. They can take their whole lifetime to pull the money out. A lot of the people that I talk to, it's I'm gonna leave my retirement account to my spouse first, and then my kids second. So I just want to make sure that's said again. Is if spouses are going to inherit, they can stretch over their lifetime. That part of the old rule stayed the same. It's really just when children are stepping into the game. I mean, there's some other exceptions as well, but like it's really just adult children who are healthy and are about to inherit their parents' money. That's when this 10 rules will apply.
So what
The 10
happens?
years rule will apply.
So what happens if the kid doesn't take the money out?
If they don't take it out, first off, you're required to take it out by year 10 no matter what. And I am going to assume that financial planners and financial institutions that hold these accounts are going to notify the kids. Maybe they don't, but I
They
assume that they
do.
will notify them. Okay, like, hey,
They
you have
usually do, yeah.
to.
But
If they're supposed to be taking the required minimum distributions, though, between years 1 and 9, if they do not take the money out, the IRS can tax that money, and say, hey, it's kind of like a penalty tax, is the way I say it. An excise tax is what they're calling it.
yeah.
If you don't take the money out, they can tax 25% of the amount that was supposed to be taken out at that time. So if you miss it, if you miss a required minimum distribution that you're supposed to be taking, you're paying more taxes to the IRS.
So not only so if I was supposed to take out the 10,000 and I didn't, I will owe a 25% excise tax on that 10,000 plus the normal ordinary tax that I owed on it. So if my
Okay.
tax rate was 25% and I didn't take it out, then I'll get my tax rate at 25 plus the excise tax at 25. So then I pay 50%. So I get to keep 5,000 of my 10,000.
Yep. That's what it comes down to.
So that's steep. So you don't want to miss that. Um,
Luckily, they do say that if you do miss it and you realize it and you correct your error, the 25% goes down to 10%. Um, you're still paying an excise tax, but at least it's a little bit less. But you have to correct it within 2 years of when you were supposed to pull it out.
oh, okay. So you got kind of
Yeah, it's still time frame on that, but
10's definitely better than 25, but 0 is better than 25.
yeah, for sure.
Don't do it. Cool. That's super helpful. So if you're leaving assets to children and you're worried about their financial maturity, you are worried that they aren't going to be strategic about the taxes, and you want a little more structure around how they're leaving the IRA. We have another podcast episode where we talked all about a standalone retirement and a trust. I believe it's episode 124.
Yeah.
Um, and so if you haven't listened to that episode, you can listen to that. And it talks about how you can leave an IRA to your children or to a spouse in a trust and the benefits of doing it that way instead of leaving it to them outright. And I think also that's where if you're going to do a Roth conversion type of thing, it can help. Also, one other thing to note, which we also talked about in a previous episode, there are a couple exceptions to the 10-year rule where you get to stretch the IRA longer. One of the most common ones is if it's a disabled individual that inherits the IRA, then Congress carved out a few exceptions. And then probably the third thing to consider too with your IRA a little bit is if you're going to do some charitable planning, sometimes it makes the most sense to make the charity the beneficiary of the IRA because charities, if it's structured correctly, can inherit an IRA without paying the income tax. So they get to keep all the money. And so if you're doing a charity at all, give them 100% of the IRA money instead of your kids 70% of that money and use other money for your kids. So those are a couple quick tips. Just, we have those covered in other episodes, but just as a refresher for anyone who's those situations might apply. Any other quick tips we want to add, Brian, before we wrap up the IRA beneficiary episode?
I think that's it. This episode is more, it's not so much of who you're naming as beneficiary as it is once somebody is named, like what is going to happen to them.
Mm-hmm.
So I think if you want to talk about more, just making sure that you get in and talk to an estate planning attorney to make sure that it's going well and it's doing what it's supposed to do. With this particular planning, I mean, it's the estate planning attorney, it's a CPA, it's a financial planner, it's the institution that's holding it. There's a lot of people involved. And something, it sounds like it's so simple, but it's just a little bit more complicated than what it just sounds like on paper, in my opinion, as to beneficiaries pulling this money out. So getting that team behind you to make sure that it's taken care of.
Yeah, definitely reach out to your trusted advisors and make sure you understand how your IRAs will work within your overall goals. And it's great to kind of, start educating your kids a little bit on how IRAs work. So when they do inherit those IRAs, they're a little more prepared to know what to do with them.
I agree.
Well, great episode. Thanks everyone for joining us. We will catch you next time on the Legacy Lawyer Podcast.
Thank you.
You've been listening to Legacy Lawyers with Michael Haslam and Nathan Croxford. We give you the juicy detail of cases that our law firm has dealt with. We take out the lawyer talk and legalese and show you what options some of our clients had to choose from to fix their situation. The effects of not doing planning can be devastating. We'll be back soon, but in the meantime, hook up with us on Facebook and Instagram at Voyant Legal. Call us at 801-951-0500 or send us an email at team@voyantlegal.com. And for commonly asked questions, hit voyantlegal.com/resources. We'll see you next time.